Well, today on Perfect Game Retirement, we're going to talk about long-term care and whether or not you should get long-term care insurance, right? Is that something that you should have as part of your plan in retirement? And how do you make that decision of whether or not you should have long-term care insurance? We'll talk about that today with Ryan Ledden at Black Oak Asset Management. He is a certified financial planner. And Ryan, let's jump right into this because I know a lot of people have this question about long-term care, but what's the main reason why people get long-term care insurance? What problem are you trying to solve?
Yeah, obviously the main reason is to alleviate from assets being completely depleted if you need some sort of care one day. And there's a huge variety of care out there. And more people seem to be needing it and using it. So long-term care has kind of turned into this like controversial topic that, should you get it? Should you not get it? Some people want to talk about it. Some people don't want to talk about it. So it's usually a very common question among most of the people that we sit down with, but then it's probably like the least talked about, or like they don't want to talk about it just because of we don't want to see ourselves as not being able to take care of ourselves. But usually the people that are very that just want a long-term care solution, and it may not be insurance, but they want a long-term care solution, is if people have had an experience with it. If they had a family member that they are taking care of and having to help out, they say, I don't want my kids, or fill in the blank, I don't want fill in the blank to have to take care of me in that capacity. So usually people want some sort of a solution. And again, long-term care insurance is the most talked about. When you say the word long-term care, people automatically go to insurance, which is a solution. There are other possible ways to alleviate some of that, but the biggest thing is we want to be able to pay for someone or help alleviate some of that monthly cost for someone who needs care, and not leave maybe the other spouse left behind with assets that have been depleted, and then they don't have a choice. If they need care one day, they're going to have to maybe go to a Medicaid facility, which may not have as good a care as something that's a paid institution to help with care one day.
Well, is the answer to this question as simple as that then? Hey, if you want to make sure that whoever is taking care of you doesn't have to absorb all these costs and it really hurt them, then go ahead and get long-term care insurance. If not, then don't worry about it. It's as simple as that. What other questions are you asking clients to help them come to an answer here?
Yeah, one, you could self-fund. That is a real thing and when I say self-fund, that doesn't mean just save a bunch of money and just know that, hey, this is going to be my long-term care bucket. But that is one strategy. You could have a separate account that is like, I'm not touching this account. This is going to be for care if I need it. And if I don't, then okay, that's just another account that my spouse or someone else I leave behind, they can just have that account and inherit that account. So that is one strategy to self-fund. I also tell people that, long-term care insurance is difficult to get. I mean, the underwriting process is extremely difficult. I've met with tons of people and they say, yeah, I applied and I got declined. So they really comb through your application. And I've said this before on the show. When I first got in the business, I was with a company that did a lot of insurance-based products, and it was a front and back application, and that was it. It asked a few random medical questions, but that was about it. And now it's a lot different than that now. So the scrutiny that you go through, sometimes it's easier to get a life insurance policy than it is a long-term care insurance policy. So just know that going in, there's no guarantee you're going to get one. And it can be expensive. Obviously, it's age-based. It used to be gender neutral, but most carriers are going to charge females more because females live longer. Actuarially speaking, they live longer. They have the tables, they have the data, they know how long men use it for and how long females use it for. So this is data driven. So they're no longer gender neutral anymore. But again, how much is your monthly benefit? Is there a cost of living rider? What is the elimination period? And when I say elimination period, that means how long are you on the hook to be responsible for the payment? Is it 90 days? Is it 180 days? So the longer your elimination period is, that's a way to save on your monthly premiums when it comes to long-term care. So that means you're responsible for 6 months and then the insurance kicks in, or maybe you're responsible for 3 months and then the insurance kicks in. So that those are ways to kind of mess with the numbers. If you do get approved, what does that look like? What are the bells and whistles that you have on there? And obviously, the more bells and whistles you have on there, the more features you have on there, the more expensive it's potentially going to be. So, and some people are okay with that premium. They just know, okay, I'm good with that. But then if it gets really, really expensive, again, that's where you need to self-fund. Or, that's why I always ask, is your house paid off? Well, if you're going to be in a facility, you probably won't need your house anymore. So that's one way to help pay for it, is to sell your house. I know you may want to keep that in the family, but at the same time, you need to pay for care. So there's a bunch of different ways to do it. I even have clients where their kids pay for the premiums for their parents because they know the responsibility is going to fall on them. So that is one possible solution as well. So a lot of things to think about when it comes to this very, very big decision.
You mentioned age. Does the answer to this question change by age? Like maybe if you're a little bit earlier on, maybe you're more inclined to get it because it costs less, or maybe when you reach a certain age, maybe it doesn't make sense anymore. Does this answer really depend on your age at all?
It has a lot to do with it. I mean, when people get to around that age 60, those premiums start to shoot up. But then some people are in their 50s and they're the sandwich generation. They're maybe still have kids at home or kids in college, and then maybe they're helping their parents already financially, and then you throw on a long-term care insurance premium, then that just gets expensive. So that premium does add up, especially if a husband and wife, when you have both of them coming in. So that's where, if you apply for it and you know what the premium is going to be, maybe apply for it to see if you get it, and then really make a tough decision on whether or not to do it. There's now life insurance policies out there. They're technically a whole life policy that you're buying a life insurance policy and you're using that death benefit to pay for long-term care. So that's how the industry's changed a little bit. It used to be, get a long-term care insurance policy. And then it's kind of changed a little bit. So they've offered some life insurance products out there that could be a solution to long-term care. So if you don't need long-term care one day and you don't need that life insurance policy to pay for it and you pass away, well, okay, then there's a death benefit on the life insurance policy. So some people are moving toward that because there's some sort of a benefit there. Hey, it's there if you need long-term care, but if you don't need it, at least there's a death benefit. I guess that's probably the biggest downside of other than the cost. But long-term care insurance, if you don't ever use it, you lose it. I guess that's true with almost any insurance, though, if you think about it. We pay insurance on our home and for obvious reasons, but maybe you don't ever have to use it. So yeah, you've paid for it your whole life, but you may not have had to use it. But if you need it, then it's there if you do need it. So a lot of things to consider again when it comes to this.
So let's kind of finish off with someone that wouldn't get long-term care insurance, Ryan. Is there any kind of clear-cut person or situation where most of the time say probably not a good decision to get long-term care insurance?
Yeah, I mean, a couple of reasons. I mean, one from health history. We can still send it through underwriting, but I can usually kind of tell based off of people's information that they give me of maybe their medical past. Like, yeah, there's probably not a good chance you're going to get it. I mean, they can even be as discriminatory as like having a knee replacement. I mean, I had a knee replacement done about 14 14, 15 months ago. And if I applied for it, I'd get declined because they asked for those recent replacements because there's a really good chance that you're going to need some sort of care for that particular procedure that you've had done. So, if people have a tough medical past and they share that information with us, then there's probably a good chance it's going to be declined. Again, still can apply for it, but it's probably not going to come back very favorable, if at all. But then if people have saved really, really well, they have a really large nest egg, and they, again, have their house paid for. Maybe they have a ton of equity in their house. So that's where if we can carve out that from my original point, if we can carve out a certain dollar amount, we look at local, because depending on where you're at in the country can really depend on how much a top tier facility is going to cost. And so we can look at that. We can look at the inflation numbers of that. How much do we need to carve off and put into a separate account? And if people can comfortably do that and they still have a nest egg where their income is taken care of in retirement, then let's do that. So you can definitely self-fund. We just want to make sure it's planned out correctly.
All right, very good. So that long-term care insurance decision is an important one, obviously. It's something you want to work through with your advisor, make it part of your overall retirement plan. If you want to work with Black Oak Asset Management, you can do so by going to speakwithryan.com to get on Ryan's calendar, or just visit blackoakam.com to learn more about their planning process and their team as well. But hopefully this answers a few of your questions. Maybe it opened up a couple more that you want to follow up with. We encourage you to do that. Also leave a comment if you have something on your mind as well. We'd appreciate that support. All right, Ryan, we'll get out of here on that note. Thanks for breaking this down for us. I know it's a little bit of a complex topic, but one that I think everyone wants to get right, and hopefully this video will help with that. So thanks.